BlackRock just pulled $2.8 billion out of crypto. At least that's what the data shows. But here's what nobody's telling you. While retail investors are panicking and selling everything at the worst possible time, the biggest financial institution on the planet is quietly repositioning itself to buy your bags for pennies on the dollar. And they've done this before, every single time. So the question isn't whether the market crashed, it's who engineered the crash. And more importantly, why they did it right now. Most people watching the charts this week saw chaos. They saw a 55% drop on XRP. They saw liquidations. They saw a fear index hit 5, which is the lowest reading in crypto history. And they panicked. But if you understand how institutional money actually moves, what happened this week wasn't chaos. It was a playbook that's been run before in 2020, in 2018, and in every major cycle before that. Over the next 15 minutes, I'm going to break down exactly how BlackRock orchestrated this sell-off using their own ETF, why the Fed is quietly injecting $90 billion into the system while nobody's paying attention, and why XRP specifically is showing strength signals that Bitcoin and Ethereum aren't. Because once you see how these three things connect, this crash stops looking like a disaster and starts looking like the biggest buying opportunity of the decade. Let's start with BlackRock, because this is the part that should make you angry. Since October, BlackRock's iShares Bitcoin Trust, IBIT, has been bleeding. Their holdings went from 91 billion and 804,000 Bitcoin down to 65 billion and 773,000 Bitcoin. That's 2.83 billion in direct selling. But here's the thing most people don't understand. When you sell $283 billion of Bitcoin through an ETF, you don't just move Bitcoin's price. You move everything. The entire crypto market trades in correlation. Bitcoin dumps, XRP dumps, Ethereum dumps, everything dumps. And BlackRock knows this better than anyone on the planet. So think about what actually happened. BlackRock sells $2.83 billion. That triggers cascading liquidations across every leveraged position in crypto. The fear index drops to 5. Retail investors, the ones who can't stomach the volatility, they capitulate. They sell their XRP at $1.10. They sell their Bitcoin at a loss. They sell everything. And then what happens? A V-shaped recovery. Buyers step in at the bottom. And who do you think those buyers are? That's not speculation. That's the pattern. It happened in March 2020 when COVID crashed the market. XRP dropped to 11 cents. Smart money loaded up. 6 months later, it was at 78 cents. The people who sold at 11 cents funded the people who bought at 11 cents. That's how this game works. And if you don't understand that, you're the one funding their trades. Now, here's where it gets interesting. An analyst pointed out that this sell-off didn't come from retail traders. The evidence is the size of the trading activity. IBIT had its highest ever trading day with $10.7 billion in volume and $900 million in options premiums. Retail doesn't move that kind of money. This was likely a hedge fund or a large institutional player trading IBIT options. And the fact that liquidations on centralized crypto exchanges were relatively low confirms it. This wasn't over-leveraged retail getting wiped out. This was a calculated top-down sell event designed to flush out weak hands. If this is making sense so far, go ahead and hit the like button, because what I'm about to show you next is the part they really don't want you to see. Let's talk about the Fed, because while everyone was focused on the crash, the Federal Reserve quietly bought over $90 billion in Treasury bills in just 8 weeks. They called it a technical measure designed to ensure the functioning of short-term money markets. That's their language for quantitative easing without calling it quantitative easing. Now here's why this matters for you. Think about the math. It only took $2.83 billion in BlackRock selling to crash the entire crypto market. It only took $6.5 billion in total ETF outflows to wipe out $800 billion in market cap. Now the Fed is injecting $90 billion. That's not a small number. That's 15 times the amount that crashed the market. And every single time the Fed adds liquidity to the system, risk on assets go up, stocks go up, crypto goes up, XRP goes up. That's not theory, that's historical correlation. So while retail is panicking and selling, the Fed is quietly adding fuel to the system. And BlackRock, the same institution that just caused the crash, is sitting there with billions in dry powder ready to buy the dip they created. That's the game. And if you sold during the crash, you just played their side of it. Now, let me tell you why XRP specifically is the one to watch right now, because there's a divergence happening that most people are completely missing. Sentiment, which is one of the most respected on-chain and social data aggregators in the space, just released something fascinating. During this entire crash, Bitcoin sentiment collapsed. Ethereum sentiment collapsed. But XRP? XRP maintained a comparatively optimistic tone across every major social platform. That's not normal. In a market-wide crash, everything usually falls together, sentiment included. But XRP didn't follow that pattern. And the price action confirmed it. Off the low of about $1.10, XRP pumped 39% in a very short period. Most other cryptos couldn't match that recovery speed. That tells you something about who's buying and why. This isn't just retail dip buying. This is conviction. The people holding XRP believe in something bigger than a chart pattern, and that conviction is what creates floors. But there's a structural reason XRP is holding up better than everything else right now, and it has nothing to do with sentiment. Ripple just acquired Hidden Road, a prime brokerage, for $1.25 billion. They rebranded it to Ripple Prime. And they just announced an integration with Hyperliquid, which is one of the largest derivatives platforms in DeFi. What does this mean in simple terms? It means institutions can now access on-chain derivatives liquidity through Ripple's infrastructure. They can cross-margin their decentralized finance exposures with traditional asset classes like FX, fixed income, OTC swaps, and cleared derivatives, all through a single counterparty relationship with Ripple Prime. That's not a press release, that's a bridge between the old financial system and the new one. And it eliminates the biggest reason institutions have been hesitant to enter crypto, which is counterparty risk. When you're managing trillions of dollars, you don't just throw money into a DEX. You need a trusted counterparty. You need risk management. You need consolidated margin. Ripple just built all of that. So while BlackRock is playing games with ETF outflows and crashing the market, Ripple is quietly building the infrastructure that makes institutional adoption inevitable. One of them is playing short-term games. The other is building the long-term system. Now here's the part where most people get confused. The U.S. Treasury Secretary Scott Bessent just testified before Congress and said the U.S. will not bail out Bitcoin. And a lot of people took that as bearish news. The market sold off even more. But let me flip that for you. Why would the U.S. government bail out Bitcoin? Bitcoin is positioned as a store of value, a digital gold. If gold drops 50%, the government doesn't bail it out. That's not how commodities work. The fact that people expected a Bitcoin bailout tells you how disconnected the narrative has become from reality. But here's what Bessent did say. He said the U.S. will retain the Bitcoin it has acquired through asset seizures. They're not selling. They're just not buying more with taxpayer money. That's actually a neutral to slightly positive statement. The government is holding, not dumping. And the fact that they're having this conversation at all at the congressional level tells you how far crypto has come. But the real signal isn't about Bitcoin. It's about what the government is doing with stablecoins. The White House just scheduled another round of stablecoin discussions with the banks for February 10th. Banks are officially joining the talks, and this is the part that connects directly to XRP. Every stablecoin needs infrastructure to move. Every digital dollar, digital euro, digital yen needs a bridge to interact with every other digital currency, and that bridge needs to be fast, cheap, liquid, and institutional grade. That's XRP. That's what Ripple has been building for over a decade, and now the White House is sitting down with the banks to figure out how to make it work. This isn't speculation. This is the timeline unfolding in real time. Now let's talk about price, because I know that's what you really want to hear. The fear index hit 5. That's the lowest reading in crypto history. Anytime we've been under double digits, it has historically marked a major local bottom. Every single time. That doesn't mean the bottom is guaranteed, but it means the probabilities are heavily in your favor if you're buying right now. XRP dumped 55% from 241 to about 1,000. It's currently sitting around 142s. The chart is showing a contraction between the 10 and 20 EMA, which typically precedes a breakout in either direction. If it breaks above 150 and the 10 EMA crosses above the 20, I think we're looking at a move back to the $1.80 range at minimum. If it breaks down, we might double bottom around $1.10. but I don't think we're making a new lower low unless some major macro event hits. And here's the bigger picture. If you compare the current chart structure to 2020, the pattern is almost identical. A massive crash, a V-shaped recovery, sideways consolidation, and then the real move begins. In 2020, XRP went from 11 cents to 78 cents in a few months. Then it went parabolic to 1.96 in the next cycle. The people who bought the crash were rewarded exponentially. A hedge fund veteran, Gary Black, just stated that Bitcoin's 50% plunges aren't a crisis. They're a feature. They're consistent with every major cycle in crypto history. And the people who have been willing to stomach the temporary volatility have been rewarded with incredible long-term returns. That applies even more to XRP right now because XRP has something Bitcoin doesn't: institutional infrastructure being built around it in real time. Now here's something most people are overlooking. The market is bearish on the potential new Fed chair, Kevin Warsh. But one analyst disputed that interpretation entirely. He pointed to Warsh's public statements supporting lower rates and notes from President Trump suggesting that Warsh promised a lower Fed funds rate. If that's true, that's extremely bullish. Lower rates mean more liquidity. More liquidity means higher asset prices. It means crypto goes up. Jerome Powell has been committed to keeping rates flat with minimal cuts. If Warsh replaces him and follows through on lower rates, the entire macro environment shifts in crypto's favor. And that shift, combined with the Fed's quiet $90 billion injection, combined with Ripple building institutional infrastructure, combined with stablecoin regulations moving forward, creates a perfect storm for XRP. So let me bring this all together. BlackRock pulled $2.83 billion out of crypto. That triggered a market-wide crash. $6.5 billion in total ETF outflows led to $800 billion in market cap losses. Retail panicked. The fear index hit a historic low of 5. But that crash wasn't random. It was a playbook that's been executed in every single cycle. Smart money crashes the market, buys the dip, and rides the recovery. Meanwhile, the Fed is quietly injecting $90 billion into the system. The White House is meeting with banks about stable coins. Ripple just launched Ripple Prime, giving institutions a direct bridge into on-chain derivatives and DeFi. XRP sentiment held strong while Bitcoin and Ethereum collapsed, and XRP's price recovery was the strongest in the market at 39% off the low. The people selling right now are the ones funding the next rally. The people buying right now are the ones who will be rewarded when the switch flips. This isn't about timing the exact bottom. It's about understanding who is building, who is buying, and who is panicking. Because in 12 months, nobody is going to remember whether they bought at 1 or 10 or 1.42s. They're going to remember whether they bought at all. Stay patient, stay informed, and whatever you do, don't let a manufactured crash shake you out of a position that's being integrated into the foundation of the new financial system. If this breakdown helped you see through the noise, make sure you're subscribed, because the next move is going to happen fast, and you don't want to be the last one to know.